Hi, everyone, and welcome to Mish's Market Minute with Mish Schneider, hosted by StockCharts TV. And today we're going to do something a little bit different. We're actually going to have a lesson on something that we at Market Gauge use. It's a little bit of a history, which I'll explain to you, but it's called trading the opening range for earnings, because there were a lot of earnings that came into this week. And I thought it would be really fun, instead of focusing on swing trades or even mini swing trades, to talk about the actual day trade, especially if it's in line with how an earnings report gaps or doesn't gap, and also the trend or the phase that the particular instrument is in, whether it's reversing that or continuing with that. So now what we like to do at Market Gauge is Keith, Jeff, and myself all were floor traders on the New York Commodities Exchanges. And the way it worked on the Commodities Exchange was that we would have most of the futures, not all of them, but most of the futures would open up month by month. So let's say you opened up with October, and that would open up for a minute or two and then close. Then they would go to November, December, etc. And then after all of the futures months were open, they would reopen. Hence, what would happen is in that initial opening, that 1 or 2 minutes opening, we would actually get a range. And then on the reopening, if the price exceeded that range from the high or went back under it under the low, that generally at least dictated the near-term trend of what was going to happen with that particular instrument. And this is a very statistically significant way to trade, whether you're looking at it for a day trade or for a swing trade, because over 60% of instruments make their initial range within the first 30 minutes of the day, which means we're looking for things that are breaking out over that range or breaking down under that range, because that means those are the exceptions and they have this large percentage chance of actually having some follow through. But there are a few things that need to go into the consideration of the opening range. And of course, being that this is only a short video, I will not be able to go into the major detail or really share with you the years of research that we've done on this, but at least give you a cursory idea of how to use it for your trading. And I think you'll have enough after today to at least watch it and then ask me questions if you want me to go further in any future video. So first of all, ideally, if we're looking at earnings, and I thought I would focus on the earnings for the obvious reason, sometimes you get huge gaps up and huge gaps down. And also we happen to be in earnings seasons, but those are very fun to day trade. But also, even if it's not earnings season, or even when it is earnings season, it's good to have an idea of the phase. And even though I'm not going to go through the phases with you, you should know from past videos that I've done that we have 6 phases that we use, bullish and bearish being the most common, and then the ones in between. And then what we're going to have to discuss a little bit today is ATR, which means average true range, because that's how we base part of our opening range breakout or breakdowns. We also use floor trader pivots. We're going to talk about that. And then a little bit on a day trade situation only, how much you would risk and what are you looking at in terms of a reward. And because I'm doing this after the day has been going now for several hours, we can actually see a little bit of the follow through based on what we learn. Not all of them work out, but it's really a good way when they do to make some decent money. Now, one of the most successful trading principles, as I just mentioned to you, for most floor traders and hedge fund managers is to be able to look at market sentiment and how that's likely to change in a stock short-term direction or an acceleration of its current momentum. And that really ties into the earnings, as I was saying, because you could have something that looks great and it gaps way lower, or vice versa, something that looked terrible and then it gaps way higher. So this is where the sentiment is part of where this opening range comes from, and that's why we want to look very short term right here. And it affects the stock market the stock's movement during the day. So the opening range trading approach provides this roadmap for somebody who has no experience trading, or the novice, or the very experienced trader. So what it's defined at is it's based on time and price. So the time element is simply the first X number of minutes in the trading day, and the number of minutes used to define the opening range is your decision as a trader. So some people would like to use maybe a very quick instrument opens, it gaps up, we're looking at it in 2 minutes, boom, we make a determination about whether to trade it. Others use a 5-minute. We're going to focus more on the 30-minute. That's sort of the industry standard for us, is a 30-minute opening range, because in that first 30 minutes, you really get to see the buyers and the sellers duke it out, so to speak. And that range that gets established is often very, very reliable for the rest of the day. Sometimes you can use a 5-minute if you want to be more aggressive, as I mentioned here. So what we're looking at in the 30-minute opening range is literally the first 30 minutes of the trading day, so 9:30 a.m. to 10 o'clock a.m. Eastern Standard Time. And as I just said, the first 5 minutes in some situations, I may use that when I want to be more aggressive. Something really gaps and it gets going, and I don't want to wait 30 minutes because it could just be so extended at that point. So while different trading styles do lend themselves to different opening range timeframes, the analysis is exactly the same on both. You're looking for the edge. So we're going to be looking at, for a 5-minute opening range, we use 3% of the average true range price confirm and a 2-minute time confirm. And for a 30-minute OR, we use 6% of the average true range price confirm and a 3-minute time confirm. So first of all, let's talk about what I mean by average true range. Every instrument, no matter what it is, has an average range, which means the price between the high and the low. That happens every day. Our average true range is on a 10-day period. So we look at the high and the low over the course of 10 days of any particular instrument, and we calculate that average true range based on the average of those 10 days. And the reason why we use a price and a time confirm for the opening range is for the very simple reason it is a great way to avoid getting chopped up by the algorithms or the high frequency trading computers. So for a 5-minute, we'll take the average true range and we'll take 3% of that, add that to the high of whatever the 5-minute opening range high was. And then we want to see it close up at that price for 2 consecutive minutes. Or if we're looking at a 30-minute opening range, we'll use 6% of the ATR. So for example, if the average true range of an instrument is $1, we'll look at literally 6 cents, and we'll put that above the high. So if the high is 20, we'll look at 20.06. And then we want it to trade at 20.06 or higher for 3 consecutive minutes. And again, this is a very cursory approach to teaching you something that's a little more complicated, but it gives you a general idea, and I get asked questions about this all the time. And maybe, hopefully, it will come clearer when we switch over to some real chart examples. So in the case of Amgen, the first thing that you have to do, by the way, is understand the phase by looking at the daily chart. In this case, when I put up the daily chart for you, you're going to see that I don't have moving averages. So I'm just going to tell you that it's been a beat up stock in a distribution phase. And also this reported earnings that were better than expected, and yet it gapped down. But also, if you want to get the average true range of Amgen, you have to go to the daily chart, and you can see here that it's about 6, which we're going to use 6 because it's a nice round number. Now we're going to go back to the 1-minute chart because I'm going to show you how we can use this to determine whether or not we should be a buyer or a seller, whether we want to follow the trend down or we want to see if this stock, after the good earnings, actually flips and reverses. So what we're going to do here is we're going to zoom out a little bit. Oh, come on, here we go. And we're going to see that this first bar right here opened up in the 1 minute. And within the 5 minutes, it made its low right here. So there was no 5-minute opening range breakdown, and there was no 30-minute opening range breakdown. So the low was established in that, by the 3rd minute, the low of the day was established at 210.28. And this is interesting. You want to make a note of that because that's going to help you. Now, I also noted that we were going to look at pivots. So in this case, we have S1 that it gapped down below, S2 that it traded down below, but interestingly enough, it actually held S3. That's about the ultimate support line that you want to see. So now we say, oh, great. In the first several minutes, not only did it break down, but now it's coming back over S2. Within a 5-minute opening range, we would want to roll up to S1. So we want to see in 5 minutes, which, by the way, the 5-minute high was made in the first minute, right here at 214.10. So remember, I was telling you for a 5-minute opening range, if we want to have 3% of the ATR and it's 6, that means we want to use 18 cents. So if you add 214.10 and 18, you get 214.28. So we would want to see pretty much before we get to 10 of or 5 of the hour, we want to see if this can confirm in 2 minutes by giving us 2 closes over 3% of the average true range of 6 for 2 consecutive minutes. Let's see what happens. So now this minute right here, and if you look on top, it shows you that, well, actually, let's go back to this minute right here. If you look all the way on the very top of the top right hand of the chart, you'll see where it says 214.28. Remember, that's exactly the number we were looking for. And guess what? At this minute, it closed there. We want 2 consecutive minutes. So we go over to the next bar, and it didn't happen. Now we go to the next bar, it still didn't happen. Well, now it started to come back again, but you could see it was chopping around. At this point now, we probably, since it didn't really start happening until as we got closer to 10 o'clock, we would now look at a 30-minute opening range breakout. Now, a 30-minute opening range breakout means that at the whatever the high was in that first 30 minutes, which is this bar right here, or 215.73, that's now what we need to break for 3 consecutive minutes using 6% of the ATR. So now we have to add 36 cents to that. So that's 9 and 216.09 is the number. So now we're looking at 216.09 to close for 3 consecutive minutes, because now we're looking at it for a 30-minute opening range. So the first bar it starts to look interesting is right here, 216.40. But then the next bar, it closes at 216.34. Okay. Now the next bar after that, look what happens. It doesn't close above 216.09. It closes at 215.09. So now we have to start again the count. So we want to look now for the next period of time that it closes over 216.09 for 3 consecutive minutes. And you can see that I'm watching the bars go by, and over here it starts to look interesting. So let's look at this bar, the bar before that. The bar before that is the first time, I believe, yes. So the bar right here at this point, almost at the 10:30 mark, or actually the 10:49 mark Eastern Standard Time, we get our first close above 216.09. Second minute mark, we get a close at 216.28, also above 216.09. Third minute mark, guess what? Doesn't happen again. You can see how you have to watch it if you're really interested on these 1-minute bars. So let's move along. Move along. Here we have 216.04, not yet. Okay, here we go. 216.09. At almost 11 o'clock, we get a close above that at 216.19. Then we have 216.15. And the third bar is 216.29. Now we can look to be a buyer. So we would put the buy order in. However, remember, we also had to talk about risk reward. So the low on this particular day, if you recall, if we go back, was all the way down here at 210. $6 on a $6 range is too much, because when you're doing a day trade, you want to risk about half to 3/4 of an ATR. If you were looking to establish this as a position, then risking 1 ATR, even 2 ATRs wouldn't be too much. But for a day trade, we probably do not want to risk more than a half to 3/4 of an ATR. So I really want to buy this stock, though. Let's just say, and I'm just picking this out arbitrarily as an example. We'll look at a couple of other examples. So now I have to say, what's a better risk? We want to risk really no more than about $3 or a half an ATR. Maybe we'd stretch it to 4. So that means the best thing to do now is to look at the pivots again. Remember, I showed you how important the pivots were. We cleared S2, we cleared S1, and even though we didn't break out to around here, we still We're holding S1. So I would put my risk right under S1 or at about 214.50. Now we're risking really for a day trade pretty good. Now, that means we also, if we're going to risk $3, we want to see if we can make $3. So we want this to be able to go to at least, let's say we bought it at 216.30 and we're risking to 214.30. We want to see this go to 219.30 before we take our first profit target. And look, it happens all the way when we get to this part here in the day, or at about 13.55 or 155. Okay, so that really is a nice day trade. So what do we do here? We take half off the table. We now go to a no loss stop. And if we're going to hold it as a day trade, we may get out by the end of the day. We may get stopped out at a no loss stop by the end of the day, or we may look for a second profit target, which would be another $3 above that, or a full ATR, and that would mean it would go all the way to R2. We'd probably get out right under R2 at around 222 of our second profit target, and then most likely hold a tail. Or on the flip side, we would get out of the whole thing and just look at it fresh the next day. And also, if it closes somewhere between 220, let's say, and 222 and doesn't quite get to target, again, make the decision to either get out at the end of the day completely or take off a little bit more and take home a tail. But that essentially is a perfect opportunity to fade a gap in this case. Now, let's look at one where it gapped up and kept going. This is Pinterest. So Pinterest, by the way, let's go to a daily chart first, so because we want to see the ATR. So the ATR in Pinterest actually expanded as the course of the day because of the big move up. But coming into the day in Pinterest, the ATR was about 320. So right now it's trading at 450. So let's use 3 just to be clear with each other, make it easy for ourselves. And let's go back down. We're going to use 3 as a ATR, and we're going to go back to the 1-minute chart. Okay, so look what happened here. In the first minute, we made a low. That low was 64.10. And the first 5-minute bar, which is right here, we made a high of 67.25. So we've already had a $3 range. We've already had the full range of the actual ATR within the first 5 minutes. So what we want now is a move, remember 3% of the ATR. So in this case, it would be roughly 10 cents. Let's just call it 10 cents. So we'd want to have to see 2 consecutive closes over 67.25. This bar we get, no, here we get 67.68. That's interesting. Second bar 67.88. Oh man, we think this thing is going to fly, and now we buy it all the way up here. But look what happens. In this case, we would probably risk maybe down to the low or right above the first minute bar because we don't want to risk that much. Again, about a half an ATR, about $1.50. And guess what? We would have been stopped out on this one. It didn't work. However, later on at the 30-minute mark, we would have never gotten in at the 30-minute mark. So this is why sometimes you have to decide how aggressive you're going to be. If you really thought that interest was going to go up, Pinterest was going to go up, and up, then you would have done the 5-minute. Otherwise, you would have done the 30-minute, and you would have never gotten into this particular instrument because it made its 30-minute opening range right here all the way at 68.80 and never had a confirmation. Later on in the day, it actually broke down under the 30-minute. But look at this. This is an example of one where it didn't work great on the upside or the downside. And that, again, of course, is where your trading experience comes in. So let's find one where it worked really well. Let's take a look at a negative. FSLY. Great example of going short a stock that gapped up after earnings, but then just wound up going down. So the first thing, of course, we have to do is look at the daily chart to get our ATR. Now, again, with FSLY, when you have these big moves, these ATRs tend to blow away. FSLY, by the way, is in a caution phase, and the ATR coming into today was $8. Okay, so it reports well. Let's go back to the 1-minute chart. But it doesn't have a 5-minute OR breakout at all. In fact, it clears R1, doesn't clear R2, and within the first 5 minutes, we get actually an opening range breakdown. The OR low in the first 5 minutes is at 70.51. Now, with an ATR of $8, let's say we say, okay, FSLY is going to go down. This really doesn't look like a good stock to me. I don't mind being aggressive and selling it. So we have to look for 24 cents below that. So we're going to subtract 24 from 70.51, and we're going to get 69.27. So now we want to see 2 consecutive closes at 69.27. This is the first time it happens, and it's right between 9:30 and 10, right at 9:45. So we want to see if we can get a second close underneath 69.27, and we do, 68.70. So here's where we decide to go short. Now, again, we have to determine risk. This half an ATR would be $41. So if we're selling it here, $4, that means we would risk up to about 73 or over R1, almost kind of the perfect risk. But we also want to make $4 on the trade. So did we go from that number of 69.20, let's say, where we might have gotten in, $4 lower to 65? And the low of the day right here was at 66. So we didn't quite make it. So in this case, now you don't want to turn it into a loser. If you don't get to your target of 1-to-1, then probably what you would do is at this point, you would either go to a no loss stop. In this case, you can see it actually cleared back over S1, but not quite where your initial risk is. So you have 2 choices. You can say, you know what, I didn't get stopped out. I'm still going to risk that same $4. You wouldn't have been stopped out, but you still would have never gotten down to a low of where it was right here. So that doesn't mean it's not a good day trade. It just means by the end of the day, you have to make a decision whether you want to lighten your position or just get out, take the couple of dollars, assuming it closes somewhere here, or just keep holding it to see if it goes lower. But that's the general rule of the opening range from the upside and also from the downside. Let's take a look at one more. Let's take a look at Microsoft from the other day. Now let's go to Microsoft on the day that it actually reported. So it reported on this day right here. If we go to a daily chart, we can see that the ATR on Microsoft is about between 5 and 6. Let's just call it 5 for now, just because this is for example's sake. So it's got a $5 ATR. If we go down to a 1-minute chart and we go back to the day it reported, look how clean that is. In the first 5 minutes where you had your low, 1, 2, 3, 4, 5, it didn't really break down, so we had to go all the way now to the 30-minute OR low. The 30-minute OR low was at 205.58. And if we're using 5 and we want an ATR of 6%, that would be 205.58 minus another 30 cents, or 205.28. We actually got a close here at 205.43, so it didn't happen. 205.32 still didn't happen. 205.22, next minute, boom. We're now at 204.48. So we're going to get short. Now, again, we don't want to risk more than $2.50 on a $5 ATR. So really, basically, we're looking at about a 207 risk, which happens to be over this pivot or over this point right here. We never get stopped out. Now, if we're going to risk 2.5, we want to try to make 2.5. And can we? We never quite make it. So again, we made a little money, but by the end of the day, guess what? If we held on, we actually got to profit target and probably would have gotten off. So essentially what we're saying here is that this is a really good way to scalp or day trade. You can position day trade by putting in that stop at half the ATR and just letting it go to the end of the day and making your determination to get out. You could take a no loss and change it and then do it again if it kicks back out. But nonetheless, these earning gaps do give you a great opportunity for you to be able to trade some of these instruments that gap up or gap down. And sometimes they happen without any earnings report, like NEO. If you look at NEO on 1029, here is your first 5 minutes, 1, 2, 3, 4, 5. It cleared R2. It actually confirmed on the opening range. Let's just take a look at here what the ATR is. The ATR, let's call it $2 just to make it easy on ourselves. So if we go back to a 1 minute, at the 5 minute mark, when it finally took out that first 5 minute ATR, that high there was 29.40. So we're going to be looking at 6 cents as a 3% of an ATR. So we want to see two closes, 6 cents over this high, or 29.48. We get it here. Oh, that's 43, excuse me. We get it here. And then we get it at the next minute. We get in, let's say, at around 29.80. We're going to risk probably about $1, 28.80. We never actually get stopped out. And so if we're going to risk $1, we're looking to make $1 at 38.88 or 31. Still in it. We're still in it. We're still in it. Boom. We finally get to our target here. We go to a no loss stop. And as time of recording, it's now trading almost $1 higher again from there. So you're almost getting a $2 out of this trade. So I hope that explains a little bit to you about using gaps, especially earnings gaps, but you can use gaps on any instruments, determining if the 5 minute is too close to the half an hour point, using the 3% of the ATR, which you can get from your daily chart, your 2 minute time confirm, or if getting closer to 10 o'clock and you use your 30-minute opening range, top of that with a 6% of your average to range and a 3-minute confirmation, remember to risk about half the ATR. Then you can go 1-to-1 on a day trade to take profit or go to a no loss stop, take more off at a 2-to-1, and then decide at the end of the day to keep a tail or not. And that's it. That's your first cursory lesson on using the opening range for gaps on earnings. Hope you enjoyed. Thanks so much. See you again next week.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.